Welcome to our deep dive on mastering the Backdoor Roth IRA conversion. In this video, we will explore how high earners can legally move money into a Roth IRA, the tax mechanics behind conversions, the Pro-Rata Rule, and how to avoid common pitfalls. We will also cover documentation best practices, including IRS Form 8606. By the end, you will know the steps to execute a clean backdoor conversion and what to watch for before you proceed. Many high earners exceed the Roth IRA income limits, which prevents direct contributions. However, the Backdoor Roth strategy offers an alternative path to get money into a Roth IRA. This is important because Roth accounts provide tax-free growth and tax-free withdrawals in retirement, subject to rules. Consequently, understanding this strategy can significantly improve long-term after-tax outcomes. Here is our agenda. First, we will define the Backdoor Roth. Next, we will review key tax mechanics. Then, we will walk through the steps to execute. After that, we will explain the Pro-Rata Rule and how to avoid it. We will also cover documentation and Form 8606, look at a quick case study, test your knowledge with short quizzes, and finish with key takeaways and next steps. Before we begin, this content is strictly educational. It is not tax, legal, or investment advice. Your situation may be unique and rules can change. Please consult a qualified tax advisor or financial professional before taking any action. Now, with that in mind, let's proceed. A backdoor Roth contribution is a two-step process. First, you contribute non-deductible, after-tax money to a traditional IRA. Second, you convert that amount to a Roth IRA, ideally as soon as the funds settle to minimize any gains. The objective is to avoid generating taxable growth between the contribution and conversion. Your non-deductible basis converts tax-free, while any gains realized before the conversion are taxed as ordinary income in the year of conversion. Here is the typical execution process. First, verify that you are indeed ineligible for direct Roth contributions due to your income. Second, ensure you have both a traditional IRA and a Roth IRA, preferably at the same custodian for smoother processing. Third, make a non-deductible contribution to the traditional IRA. Fourth, wait for the funds to settle, which can take 1 to 2 business days. Fifth, convert the contributed amount to the Roth IRA as soon as possible to minimize taxable gains. Sixth, keep thorough records and file IRS Form 8606 to document your non-deductible basis. Finally, confirm your aggregate non-Roth IRA balances as of December 31st, because the Pro-Rata Rule uses year-end balances to determine the taxable portion. Let's clarify the tax mechanics. The non-deductible portion of your traditional IRA contribution is called basis, and it converts tax-free because you already paid income tax on it. Any investment gains that occur before the conversion are taxable as ordinary income in the year of conversion. Therefore, timing matters. Converting as soon as funds settle reduces the chance of realizing gains that would be taxed. All of this hinges on proper documentation. Filing IRS Form 8606 is essential to record your basis and avoid being taxed twice on the same dollars. In this example, you contribute $6,500 of non-deductible money to a traditional IRA, which establishes your basis. Suppose the market goes up by $50 before you convert. When you convert $6,550 to your Roth IRA, $6,500 is tax-free basis, and $50 is taxable ordinary income in the year of conversion. Converting quickly can reduce or eliminate this taxable gain. Quiz time. If your traditional IRA contribution earns a small gain before conversion, what happens to that gain at conversion? Option A. It converts tax-free along with your basis. Option B. It is taxed as ordinary income in the year of conversion. Option C. It is taxed at long-term capital gains rates. Option D. It becomes tax-free after a 5-year clock. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Any gains realized between contribution and conversion are taxed as ordinary income in the year of conversion. This is why it is recommended to convert as soon as administratively possible after the funds have settled. Here is the big warning. The IRS aggregation rule requires you to consider all of your non-Roth, non-inherited IRAs, traditional, SEP, and simple when calculating the taxable portion of any conversion. Only a percentage of the converted amount can be treated as non-taxable basis, and the remainder will be taxable. If you have significant pre-tax IRA balances, the backdoor Roth can become inefficient or even counterproductive. The calculation uses year-end balances as of December 31st, and failing to document your basis using Form 8606 can lead to double taxation. This pie chart illustrates the total composition across all non-Roth IRAs. In the example, there is $6,000 of non-deductible basis and $94,000 of pre-tax funds. Under the Pro-Rata Rule, any conversion pulls proportionally from both pools. As a result, only a small fraction of the converted amount is treated as non-taxable basis, while the majority is taxable. This visual helps explain why large pre-tax balances reduce the efficiency of the backdoor Roth strategy. Let's run the numbers. Suppose your total non-Roth IRA balance at year-end is $100,000. And your non-deductible basis is $6,000. You convert $6,000. The non-taxable portion equals basis divided by total multiplied by the conversion. 6,000 divided by 100,000 times 6,000 equals 360. Therefore, $5,640 of the conversion is taxable. This is the pro-rata effect in action. To avoid the pro-rata trap, consider rolling pre-tax IRA balances into an active employer 401k if your plan allows it, thereby removing them from the IRA aggregation pool. Aim to have zero non-Roth IRA balances on December 31st in the year you execute the backdoor conversion. Execute the contribution and the subsequent conversion close together to minimize gains. Maintain thorough records and file Form 8606 each relevant year. Finally, coordinate with your plan administrator and a qualified tax professional to ensure proper execution. This timeline shows a clean execution. In the first quarter, make the non-deductible traditional IRA contribution. After 1 to 2 days, the funds settle. Immediately afterward, convert to the Roth IRA. During tax season, file Form 8606 to record your basis and the conversion. By December 31st, verify that your non-Roth IRA balances are zero to avoid pro-rata complications. Form 8606 is essential because it tracks your non-deductible basis and any Roth conversions. If you fail to file it, you risk paying tax on the same dollars more than once. Ensure each year you make a non-deductible IRA contribution or perform a conversion. The corresponding Form 8606 is completed accurately. Retain confirmations from your custodian showing the contribution and the conversion details. Second quiz. Which accounts are aggregated under the Pro-Rata Rule when determining the taxable portion of a conversion? Option A. Only the IRA used for the conversion. Option B. All non-Roth, non-inherited IRAs, including traditional, SEP, and simple. Option C. Only traditional IRAs with contributions this year. Option D. Roth IRAs and HSAs. You may pause the video now to think about the answer. We will discuss the answer in the next section. The correct answer is B. The IRS aggregates all non-Roth, non-inherited IRAs, including traditional, SEP, and simple. This year-end aggregation can make backdoor Roth conversions inefficient when large pre-tax balances exist. Here is a quick comparison. The strategy shines when you have little or no pre-tax IRA balances, when your employer 401k accepts rollovers so you can shelter pre-tax funds from the pro-rata calculation, when you can convert quickly after settlement, and when you value additional tax-free growth. Conversely, it can backfire if you have large pre-tax balances sitting in IRAs that you cannot move, if you fail to file Form 8606, if you delay conversion and generate taxable gains, or if your employer plan does not accept rollovers. These are the key points. The backdoor Roth allows high earners to access Roth benefits within IRS rules. Convert promptly after settlement to minimize taxable gains. Watch out for the Pro-Rata Rule, which aggregates all non-Roth, non-inherited IRAs. When possible, roll pre-tax IRA balances into an employer plan to avoid the aggregation. Always file Form 8606 to document your basis. Finally, consult a qualified professional before you act. To summarize, you now understand the steps to perform a backdoor Roth, the tax mechanics that drive the outcome, and why timing matters. You have seen how the Pro-Rata Rule can undermine the strategy and how to avoid it by managing year-end balances. You also know the importance of filing Form 8606 to protect your basis and avoid double taxation. Next, consider your own situation and coordinate with professionals as needed. Thank you for watching. If this was helpful, please like, share, and subscribe for more detailed guides. Post your questions and your own experiences in the comments so we can learn together. See you in the next video.